Okay, welcome to today's session. Jason Roccasalvo here, partner of TAG Superannuation Advisory and Audit Division. With me today is Emma Partenza, manager in the division. G'day, Emma.
Hello. Hi, everybody.
Okay, so today's session is on how to run a self-managed super fund. So really looking at the, the pros and cons and some of the things to watch out for as a trustee of a superannuation fund. So for those that already have a super fund, this is hopefully a little bit of a refresher and a confirmation of things, hopefully, that you're already doing well. For those of you that don't have a super fund, this will just give you a little bit of the idea, of the responsibilities, the roles, maybe even some of the terminology as well, just so you get yourself a little bit familiar before you take that plunge. Obviously, the information we're talking about here today, everything really in this presentation is general in nature only. So, if you're thinking about starting a superannuation fund, really the best thing to do is to obtain proper and thorough personal advice around that. Make sure it is in your benefits and you understand everything you're getting into, like anything you would otherwise do. Okay, so really when we're talking about a self-managed fund, some of the things that we need to think about is, well, what makes it attractive to people? So, a self-managed fund is self-managed. So I guess by definition and in its simplest sense, people like the self-managed space because it provides them with full control over their retirement wealth. Okay, so if you're a member in a larger fund, a retail or an industry fund, you might have a little bit of flexibility in terms of what they allow you to invest in, but pretty generally you're going to be selecting and jumping in various pools, asset classes, etc., based on your choices. A self-managed fund, full control, that does therefore provide more direct yay or nay decision-making power around what your retirement wealth is invested into. With that, obviously, therefore, is a wider range of asset choices that you're able to look at. You've got full flexibility from a self-managed fund, any listed asset that you want to choose, whether that's listed in Australia or overseas. You really the only real barriers you see there is your barrier to be able to sort of have an account to access certain stocks, but that's no different than if it was you trying to invest personally. Particularly on a self-managed fund, and you hear a lot of talk around this, is self-managed funds investing in direct property. So whether that's residential or commercial, it does sort of expand that opportunity. I know a lot of larger funds invest in direct property, and they're often sort of CBD high-rises and those sorts of things. The self-managed fund space allows you to directly own yourself the entire asset. Full transparency is a huge factor. So transparency is key, especially in this day and age. We do see a lot more discussion from the ATO and from the federal government around transparency, whether that's consistent reporting across funds as to the expenses that the funds are incurring, whether they're direct member expenses, things like marketing expenses, those sorts of things. You often don't have both a consistent and a clear level of transparency in a retail or industry fund around those sorts of costs. Equally as well, transparency in terms of the earnings. So what you've often got in these larger funds is investment reserves. So each year those funds are providing or earning levels of income. Those investment reserves don't necessarily mean that all that income is passing to you as a member. Some of that goes into investment reserves and is used to smooth out allocations and yields to members of superannuation funds. So again, that lack of transparency is probably one of the bigger factors, and that does tie into why people want that full control. Estate planning as well, that's another big benefit. So particularly in the self-managed fund space, you've got a little bit more again, direct flexibility and direct choice as it relates to your estate planning wishes. So that's another huge factor that we see people really value, particularly as they're sort of more, transitioning into retirement and having to start contemplating those things. The other factor as well is self-managed funds can now have up to 6 members. So it gives you the power to pool your superannuation wealth with others. That might provide collectively, typically a family group, I guess, with a little bit more purchasing power, but it also helps perhaps smooth out the costs across the 5 of you. So we see that as a particularly strong choice. Again, within family groups, that's a big thing. So it was 4 members. It's expanded up to 6 members now that a self-managed fund can have. Additionally, in terms of what makes a self-managed fund attractive, so, it's very generally people having a greater connection with their retirement wealth. So, you might often be focused on your current day living needs and those cost pressures. You might be a business owner and you're focusing directly on your business. What often gets left behind or forgotten about is that retirement wealth. So, having a self-managed fund does increase that connection. It's not so much about the control. It's probably a little bit more around that plan and action and thought process, so that you're not waiting. And Emma will touch a little bit on things like sole purpose, and we'll talk about retirement income strategies a little bit later. But just increasing that connection with the retirement wealth earlier does pay dividends down the road. So that often is a huge factor for self-managed funds. Equally as well, you've got a little bit more flexibility around contributions and withdrawals. What does that mean? It doesn't mean you can take money out whenever you feel like it, irrespective of your age. You've still got to comply with the regulations and the legislation there. Where we're talking about it on withdrawals particularly is you've got a little bit more of a time lag that works in your favour to decide whether particular withdrawals, I guess, are pension withdrawals or lump sum withdrawals. They have different tax treatments and different reporting requirements as well. When you're with a larger fund, you often have to make that distinction and that decision before the money is released out to you. Okay, so having that flexibility does provide the time to sit back and dwell and make sure that you're making, I guess, the most educated choice around how your retirement wealth is flowing back out to you. Conversely, on the contribution side, you've got that flexibility. So we see this often get used to its full advantage where people are looking to claim a personal tax deduction for contributions. That personal tax deduction is still subject to the normal contribution caps, but you can't claim a personal tax deduction if you don't have enough taxable income to create the deduction, so you can't create a loss because of it. And so often what we see with people making contributions personally to a self-managed fund is they, in time, when they have a full picture of their financial year's personal tax affairs, make that decision around what component is a deduction and what component is considered a non-concessional contribution. You have that fullness of time again to wait and see how the dust settles before you make that decision. As it relates to an industry or retail fund, you often have to make that decision at the time you make the contribution. Okay, so it can often be something that you're almost taking a little bit of a leap of faith on. The last point that we've got here today when we're talking about self-managed funds and their attractiveness does tie in with that top point that I've got, but really about assisting business owners. So we often see this here at TAG, and we often see it throughout the industry. The self-managed fund is typically invests perhaps in a business premises. That business premises is leased to the business. That allows the business owners to maintain their focus on the business, which is often the be all and end all. It's every waking hour of every day they're thinking about their business, but it also allows them to bring their retirement wealth on that journey as well without having too much thought. So the self-managed fund for the business owner, again, is quite a powerful tool because it allows their business to flourish and their retirement wealth to come on that journey as well. And we see that as a really popular thing. Before I go into some of the negatives, just a little reminder, feel free, if you've got any questions, just the chat should be on the right-hand side of the page here. So you're more than welcome to type any questions you want in there, and we'll answer them as they come through or towards the end of the session, if I'm getting a bit tongue-tied. As it relates to the pros, there's obviously also some negatives as well. So What are those pitfalls? Well, typically the biggest thing you've got is a time commitment. So, you know, as trustees, you are personally responsible for those decisions. Does that mean that you have to be the only one making those decisions? No, you can engage obviously professionals to assist you along the way. But there is a time commitment there that needs to be considered. Another big factor that I see very commonly with people as they're entering into the self-managed fund space is just as an adjustment to get yourself ready and steeled for, is that you directly feel every bump along the way. And what does that mean? Well, if you've got a self-managed fund, you're going to need to write the check for that self-managed fund to the ATO each tax year. You're going to need to write that check from the self-managed fund's bank account to the auditor, to the accountant each year for the tax return and the annual audit. Okay, so you're directly feeling all those bumps along the way. If you're in a retail or industry fund, you see your bottom line and all those bumps have been removed for you. So you don't, again, tying that back into transparency, it is there in member statements in bits and bobs, but you don't necessarily directly feel those bumps. That can be a good thing, but it also can be a negative, but it is an adjustment that's really prudent to think about. The other thing to think about as well is the temptation side of things. And we'll talk about what you can and can't do in a minute and what to watch out for, but your super fund does need its own bank account. You will have access to that bank account, but you can't touch it because the money needs to stay in the fund. So it's one of those, it's yours and you've got multiple hats. It's you as trustee and then it's you as an individual. They're two separate things. So I'll hand over to Emma now, and we'll just move into some of the key roles and responsibilities around a superannuation fund.
Thank you, Jason. Yeah, first we'll touch on some key roles in running a fund, and I guess the most critical document for a self-managed super fund is the trust deed, because the self-managed fund is a trust. The deed essentially is the governing rule, so it tells you as trustees essentially what the fund can and can't do. There is some, even though we have the superannuation legislation, there are some aspects of super not in the legislation, and that's purely driven via what's in the trust deed. So for example, limited recourse borrowing, being able to borrow for certain assets and things, going into pension phase, estate planning, putting binding death benefit nominations in place, and what you can and can't do around those types of things. So very, very vital piece of information. The auditor will want to see it. And it's prudent that we keep it updated, roughly, 5 to 7, maximum sort of around 10 years, or unless there's some sort of major legislative change that may impact your situation during that time. In terms of member and trustee, essentially you will act in different roles. So as Jason said, you'll have your member hat on, you'll have your trustee hat on. Those are two different things. You've got two different responsibilities. Member, obviously you're concerned with your retirement wealth and how that's growing for your eventual retirement. As a trustee, the trustee owns the assets of the fund, what your money is being invested in to provide for your retirement. The trustee doesn't personally hold it, so there needs to be a distinction of the assets of the fund versus, what the trustee owns personally. The trustee sets out the investment strategy in how it's going to achieve, a great outcome for the member's retirement. And sort of more the general, overall see of the day-to-day management and running of the superannuation fund. In terms of the trustee structure, so the composition of a fund, you can typically have a corporate trustee in which the members are directors, or we can have an individual structure. So all of the members will be individual trustees of the fund. We do recommend a corporate structure because you can add and remove members and directors being one and the same. We can add kids, we can remove, we can, do whatever needs to. Someone might pass away, business partners split, whatever happens in the future. A corporate trustee is best placed to allow for all of those changes without having to sort of change all of the investment names and things like that to be in the name of the trustee, being the corporate entity. So as I said, you can always remove, we can make changes along the way and that sort of thing, but it's probably best to start off with the corporate trustee. And in terms of how do you stay on top of everything, well, as Jason sort of alluded to, you've got advisors to help you. So as a requirement under the legislation each year, obviously you need to lodge a tax return for the fund. It needs to be audited each year. That's a legislative requirement. You might not be sort of au fait with investing, so you might seek the advice of financial advisors and that type of thing. So certainly there's lots of professionals that you can assist with the running of your self-managed fund for your retirement. But you need to know or be aware that the ultimate responsibility does lie with you as a trustee. That's quite critical. In terms of the sole purpose test, now this is the key to superannuation, and the sole purpose test, its main purpose, obviously, of superannuation is to provide benefits for your retirement and then ultimately to beneficiaries in the event of your death or your disability. Now, if the trustees comply with the sole purpose test, then the government will give you tax concessions. So the fund is concessionally taxed at a maximum of 15%, 10% on some capital gains if you've owned them for greater than a year, or if you're further down the line and you're sort of in the retirement phase of life, you might even have full exempt income tax on the income in your fund. So you do not want to contravene this test. In terms of no immediate monetary, non-monetary benefits, essentially the sole purpose is here to provide for your retirement. As Jason said, you don't want the temptation of dipping into your money because it's there. There is no access to present day benefits, even though it's sitting there and you control it and that type of thing. You can only receive superannuation upon your preservation age, which, depending on your birthday, is somewhere between 55 to 60 years old. And when I talk about a current day benefit, a few examples might be, you might be a keen art collector, purchasing of artwork. You just can't hang it on walls at home and, look at it when you're having a coffee every morning, that type of thing. Residential property, you might own one in the fund, but you can't go and rent it out. You can't sort of live in it. You can't go and have holidays in it, or your sort of immediate related parties to you, and that type of thing. So it's critical that there is there is a lot of investment choice, but there's just be critical aware of the restrictions on different types of investments. Okay, ins and outs of super. So on the inside, obviously the super fund can accept contributions, it can receive rollovers, all of your money can go into the fund. It's building up the wealth for your retirement. We've got two types of contributions. You've got your concessional contributions, which are taxable in the super fund, and because they're pre-tax monies. So they're sorts of, your employee super guarantee from employment, or you might put a contribution in but claim it personally if you've got sufficient taxable income and the like. So you get a tax deduction, the fund pays income tax. So your cap on those is $27,500. That is increasing from 1 July this year up to $30,000. On the other side, you have non-concessional contributions. That per annum is $110,000, and that's tax-free money going into the fund. So that's money that you've accumulated. You've already paid tax on somewhere along the line, and you want to pop that into the superannuation fund. That goes in tax-free. There's no tax deduction that any one or entity receives. There's a potential to bring forward 3 years worth of contributions as a non-concessional. So you might be entitled to, say, put 330 in a financial year, even though the cap's 110. again, there's restrictions and caps and things like that, but that's a possibility as well. Now, the last couple of years, there's no longer a work test applicable for making non-concessional contributions, and it's sort of been extended out, this bring forward rule of up to 330 post age 67. So it's giving those up until age 75 greater opportunity to sort of really build the wealth, maybe at a point where they're greater ability to do so. Again, the non-concessional cap is increasing from 1 July this year. It's going from 110 up to 120,000 per financial year. So obviously contributions coming in, building up your benefit in the superannuation fund. So these are into the fund. Rollovers and transfers. So you might have external super that you might then want to consolidate into your superannuation fund. It's not a contribution, so there's no taxing point, just rolling over existing super into this super, and that's now via SuperStream. And then you go through the life cycle, and then at the other end, you're retiring and we can pay benefits out to members. So preservation is really when the member can access benefits. And again, that's sometime from age 55, potentially up till 60. But it is then also based on if the member satisfies a condition of release. Typically, if they retire or they turn age 65, being the common ones. Retirement post 60, you're able to access your benefits. If you turn 65, doesn't matter whether you're working or not, the government want you to start accessing superannuation. So that's an automatic condition of release. So it's just about what do you satisfy, and in terms of being able to access and start taking pension from your superannuation fund. And then lastly there, we've got types of payments. So really that comes down to whether we're paying you as a pension or as a lump sum. They both have different taxing requirements. To members over 60, you receive a pension. You don't include it in your personal tax return because the money essentially goes out to you tax-free. You might use a lump sum, you might turn 65 and have full access, but a pension may not be for you. You still got full access to your money, and you might just take ad hoc payments out. So, you're taking lump sums from the superannuation fund. So regardless of how we take the money out, we need to be of preservation age and have satisfied a condition of release to access your benefits. Okay, now in terms of investment restrictions, it's quite there's lots of yes you can, no you can't, or you can if you do this different. So it's best to be aware of the restrictions and things around what you are trying to achieve in your superannuation fund. Now, loans and financial assistance. The fund can't provide financial assistance to members or related parties. So generally can't do any of that. So don't contemplate just taking out $5,000 because you need the money if you don't satisfy any of those conditions of release and preservation requirements. The fund can acquire assets from members, but there is restrictions here. So it can't acquire residential property, for example, but it could acquire listed shares or business real property. So that's commercial property. So again, you can buy certain things. So just a matter of what you're trying to achieve, and sort of speak to us about any restrictions and things before you undertake such transactions. In terms of borrowing, typically a fund can't borrow, but there's an exemption in place for what we call a limited recourse borrowing arrangement. There is lots of rules around it, so it's a completely separate topic in its own right. Essentially see us if you're interested, because the fund can borrow to purchase, a property if it doesn't have sufficient cash and resources to do so, and it will pay pay the bank back, and there's all sorts of requirements and how you need to hold that asset and things like that, which I don't think we'll get into today. But typically borrowing is out, but we can do for purchasing of a particular investment. Investing in related parties, again, lots of rules and restrictions here. So look, I think I'll just say that lots of planning is required, because if you think about sole purpose is for your retirement, you've got the benefit of dealing with each other, you know, with related parties. It still needs to be sort of on a commercial basis. You can't get incentives and things just because you've got the benefit of dealing with, you know, those around you. Yeah, you can't get benefits for doing so that other people wouldn't necessarily be able to do. In terms of everything needs to be at market value in the fund, and as I said, all dealings need to be sort of on a third party arm's length terms. Now that really comes down to buying, renting, leasing, everything, as if you weren't dealing with a related party or yourself in another with another hat on. Yeah, it's dealing as though you were dealing with, you know, a third party all of the time. Collectible investments, very, very restrictive. Lots of requirements here, nearly to the point that it's really not worth holding unless you were a very, very keen, you know, collector. There is restrictions around insuring it, storing it, and various things like that. So if you're interested, probably again best to to come and speak to work out, you know, whether it's beneficial for your fund to hold such an investment or not, before you go ahead with doing that. Okay, common mistakes. So the ATO. The ATO have a concern that they don't want, obviously they don't want more money coming into a superannuation fund than's allowed, or you know, illegal early access, or more money coming out than entitled, that sort of thing. So just refer back to the sole purpose test. It is for your retirement, and it's a highly sort of regulated area. We've seen on establishing a self-managed super fund, the ATO becoming more, asking a lot more questions when we're establishing funds these days, to sort of weed out anyone that really shouldn't have a self-managed fund. They're increasing calls to trustees who, obviously because a fund needs an ABN, so we're dealing with the ATO to get an ABN and these types of things, so you can get a bank account and set up the fund. You don't necessarily see all of this, but they will contact trustees, or, you know, there'll be red flags if certain things don't sort of match up. In terms of, you know, you might have incomplete personal details or inconsistent details with the ATO that may cause red flags. You know, you might you know, your name on your driver's license, passport might be a full name, but you go by a preferred name, and that's registered with the ATO and various things. So, or your other superannuation fund where you're rolling over, you know, doesn't have a middle name, or all those types of things need to get everything in order and consistent, so there's no delays in setting up a fund, because that is going to cause a delay in getting an ABN. That is going to then cause a delay on receiving rollovers, and sort of if you've entered into, you know, a property purchase and that, you know, that time is counting down, you need to be really conscious of, you know, it could take a couple of months to set up a fund. It then may have a flow-on effect to, you know, your employers being able to make super guarantee contributions into super when you don't have an ABN. So lots of things at the get-go that just need to be aware of to ensure smooth sailing and setup of the fund. Loans, investments involving related party borrowing issues. We sort of covered that. It's a very highly regulated area. As I said, there's restrictions on what you can do, what you can't do. So always ensure before you enter into something that you're fully aware, so you're not contravening any of the superannuation legislation. Have I missed anything there, Jason?
No, it looks good, Emma. So yeah, I just typed in there. Look, yeah, essentially it is just about getting more money into super than you're eligible to, because of contribution caps, and or taking money out before you're eligible to because of your age, and essentially, you know, they're the risk areas that the ATO looks at. So that doesn't preclude investments with related parties, but obviously an area of focus for the ATO is that you're not investing with a related party and somehow shifting wealth out of super to you or to you personally before you're eligible to. Okay. On the flip side, you're not shifting wealth into super by funneling more income into super than the fund is otherwise eligible to. So yeah, Emma, you spoke about arm's length transactions before. There's got to be a fair, reasonable and accurate commercialness around all transactions, particularly when you're involving related parties. So it could be a business that you run or the individuals personally. Yeah, it's all got to be above board and consistent.
Yep. I probably didn't say there that, you know, it needs to be valued at market value sort of every financial year as well. So getting the appropriate documentation to support that. Because yeah, it'll affect your benefit and value, and then flow on effects for being able to contribute or not the following financial year. So yeah, that's
right. So your valuations is huge because of those. The size of the balance can impact the amount that you can contribute, and the size of the balance can impact the amount you can have in pension mode or the minimum amount you have to take out in pension mode. So yeah, market valuations are always needed each and every financial year. Cool.
Okay, retirement income strategies. So referring again back to the sole purpose test, you know, the purpose of superannuation is growing your wealth to provide income for your retirement. So as a trustee sets out, you know, an investment strategy, they also need to look at, you know, at the end of the life cycle when members, you know, potentially reach that stage, want to start accessing, you know, their benefits, you know, in the form of an income stream, lump sum, whatever. You know, what's the game plan to achieve that? How, you know, is the fund liquid enough? Does it have the cash flow? Does it have the type of investments that are adequate enough to? So, you know, a reevaluation sort of needs to happen, you know, at that stage of the cycle. Jason, what would be the key drivers for a type of plan for a retirement strategy?
Yeah, and look, this isn't necessarily unique to self-managed funds. So, you know, every single one of us that has a superannuation balance, you know, through our working lives, we should always be thinking about what our retirement is going to look like. So in some way, shape or form, you know, what we're doing with our super should always have a purpose. So what that purpose is, you know, am I going to have enough in retirement? So what are some of those key drivers? You know, often we find that, you know, I guess TAG's philosophy and the investment advisory and wealth guys here at TAG, you know, I feel like the philosophy that they apply, and when we're looking at these things, you know, a strategy often is driven by, I guess, your age. So the younger you are and the sooner you start thinking about your retirement strategy, the more time you have for that strategy to take hold. Conversely, I guess the older you are, the less time you've got to make decisions that can alter and have a positive impact on that strategy. You know, income. So what sort of income are you earning? What sort of income are the assets that you've got earning? Because that's really important to consider as far as your assets grow. That's an important factor to consider. From the expenditure side, you're thinking about what is outflowing from your superannuation fund. I think you also need to think about what does your retirement look like. how much do you think you need to live off now while you're working, and then what do your assets need to be earning for you when you retire to be able to provide you with a desired level of retirement income. And I guess considering all of those factors, where are you now? And the biggest thing, we see as it relates to, the wealth accumulation outside of time, the biggest control that we've got is what we spend. We often don't have, as much as we'd like to, we often don't have control over how well our investments do. So, having control of those factors is really important, because and understanding those factors is really important. As I said, our investment advisory and wealth guys really have a nice way of sort of looking at that and trying to articulate that visually, sort of understanding what sort of trajectory and plan that you're on, and then how that will look as you work your way to retirement, and how that will look as you hopefully live your way through retirement. And really from there, just enabling people to sort of, I guess, get an understanding better about where they are now with their wealth, and will their wealth on this trajectory be able to deliver what they want. And if you need to make changes, then obviously you're considering how that investment mix could need to be altered to make the appropriate changes to give you the best chance of achieving those objectives in retirement. As I said, again, tying that back to the bumps and bruises along the way, you're a bit more directly involved as a trustee of a self-managed fund, but this strategy, these thoughts really should apply to everybody as far as how they're thinking about what their retirement means to them. Too often we just have our employer putting super guarantee in regularly, and it just goes up, and we're not thinking about what our super is invested in. That probably typically rings more true for those people that aren't in a self-managed fund, because people typically have their self-managed fund, so they've got that control. But we should all have, I guess, an understanding of what we're trying to achieve, and then how do we go about trying to achieve. So thinking about what that end result needs to look like, what my retirement is going to look like. So for any of you, if you're interested, clients of our investment advisory and wealth division sort of already get themselves through, I guess, that process and have that sort of reviewed and assessed quite regularly. But that process is offered to anybody. So if you are interested, feel free to send either Emma or myself an email, and we can arrange that sort of complimentary meeting to talk about it a little bit more, and what it means to you. As I said, so where can TAG help? So, Emma and myself heading up the superannuation advisory and audit division. So whether it's about, establishing a fund, the annual compliance obligations of the super fund, so the accounting, tax work, engaging with an auditor for that work. TAG has that investment advisory and wealth division, so that investment monitoring and advice, again, being quite personal and direct for your needs. And that compliance side. So every year a set of financial statements needs to be produced, a tax return needs to be submitted, an audit on all of those needs to be conducted. And in exchange for that, you get a 15% tax rate on your superannuation fund. So assisting on those compliance needs. Equally as well, you might have specific, some of those more nuanced investment choices that you might have some specific questions about. We've had people sort of asking us recently about investing in businesses with other people, investing in certain types of property with other parties, and whether that's feasible or not. It's always worth obtaining advice, no matter what it is, obtaining advice before you jump in and make an investment choice. So TAG can help in any way, shape or form. As with any non-client, we're more than happy to have a complimentary meeting to discuss how we can potentially help. So if that is a matter that does interest you, feel free to reach out either to the team at tagfinancial.com.au email address, or the super@tagfinancial.com.au email address. Feel free to reach out to either of those. They'll filter their way through to Emma and myself, and we'll be able to help you out in any way. But if there's no further questions, then welcome, and thank you again for coming. Appreciate your time, and we'll see you again soon. Thanks, guys.
Wonderful. Thank you.